Chris Armbruster is joining as a research analyst at Kane Anderson Rudnick. We got Kevin Hanks in studio with us to trade here in a sec. So Chris, tell me what you're looking for as analysts this earnings season. I mean, are there sectors that clearly are best poised to see finally some earnings growth pick up? Are there places you want to avoid? I mean, it's time to get fundamental, right?
Right. I don't think that we're seeing any sectors that we're particularly attracted to over any others. I think that there's a lot of disruption going on in multiple sectors in the economy enabled by technology, but technology is clearly benefiting things like consumer staples, consumer discretionary names, even some industrial names we're seeing where technology is having an effect. And overall, we're pretty constructive on the markets. I think we've climbed the wall of worry. Trade is moving in the right direction. The yield curve is no longer inverted. The consumer seems to be in pretty good shape. And overall, we're not seeing some of the signs that we've seen in the past with kind of blow off top markets. One of the things that we noticed was last year about 150 billion had been pulled out of equities, which is very unusual to see when you have markets at these levels.
Yeah, I love that you bring that up. A lot of money coming into bonds still throughout last year, and flows moving in the opposite direction for stocks. You've got a couple pretty interesting picks here that are both, I would describe as consumer-related stocks. I think that's interesting because now one of the questions out there is, all right, is the consumer in the U.S. still going to have as much strength as it's had, kind of being that linchpin for the economy the last year? Is now still a good time to expect more growth? Is there going to be incremental growth for the consumer? Because a lot of stuff I hear right now is, let's just hope they can stay at the level they're at.
Well, with employment where it is and wages rising, it doesn't seem like there's any sort of macroeconomic headwind for the consumer at this point. And the names we like are names that benefit from longer-term secular trends that don't necessarily change when the economy takes slight gyrations in one way or the other.
Okay, let's talk one, GSX. I want to go there first. This is a pretty interesting stock. China-related name, has a lot of exposure in education, tutoring. The shares have been doing pretty nicely. Walk me through the case for GSX.
Yeah, so this is about an $8 billion company now. It's had a good run since its IPO, but in general, after-school tutoring is kind of a way of life in China. I'm not sure that we fully appreciate how important it is to the Chinese people. Competition for universities is very high. With the one-child policy or two-child policy, the cost of failure is very high for a lot of families. So about 50% of Chinese participate in after-school tutoring, and they can take about a low teens % of their annual income and spend on that. And historically, we've seen the industry really focus on the brick and mortar players. There's a couple of brick and mortar players. Even though you have a fragmented market, you have a couple of leaders in the space there. And what one of the former presidents of the New Oriental brick and mortar operator did was create an online platform. And the online platform has the inherent advantages of having lower capital intensity, lower fixed costs, so they're able to pay their teachers better. And they were able to attract and retain some of the top teachers in the country. And this has allowed them to boost enrollments and also reach tier 3, tier 4, lower tier cities that typically didn't have access to this type of top teacher education.
So is there a tech element to this about bringing tutoring onto an online or a sort of more margin enhancing way than peer-to-peer interaction? Because I know there's some of the companies that have been targeting that type of higher margin type business within educational development. Is there a component of that here or no?
Yes, leveraging the online platform is a much better cost structure than having the brick and mortar business. Online classes are, more time efficient because you don't have to drive to and from the facilities. They actually end up being cheaper, and you can do larger class formats. So a lot of their classes are over 1,000 people. They have teachers' assistants that help make that possible with the individual student interactions. But you can leverage a single teacher across a broader student population through an online platform.
So when we talk about the profitability, I mean, are they making money at this point?
They are going to be, I think, EBITDA positive next year or in 2020.
Okay, because a lot of these stocks we've been watching, they've gone exponential, right? They're on a path to profitability. Let's talk another one here, Freshpet. I think our viewers know this one a little bit more. We've been talking about this company a few times here on our Overlook Stock segment. It's gone berserk. So when we look at the shares, I mean, how do we assess just how big this market is? We've seen stocks like Chewy, struggle a little bit. Freshpet, on the other hand, not so much. It's like organic pet food.
Yeah, well, I think that humanization of pets is a long-term secular trend. People are spending more and more of their disposable income on their furry friends. But what you've seen is that fresh pet food is still a very, very small percentage of overall pet food. It's something like 3% or something like that. So you have a lot of room for this to increase in penetration. And Freshpet has built a really nice business with some really good sustainable advantages. One of the things that they did is they invested about $70 million up until this point installing fridges at their retail partners. And so the square footage has already been kind of committed to Freshpet, and it's very attractive for retailers to have these refrigerators in their stores. I think it increases sales per square foot something like 20% in their grocery partner stores and 60% at their pet specialty stores.
Is there like a safety element to this where people will dial down their own, expenses and keep it the same for, the pet?
Yeah, it's funny. We did hear about that back in 08, 09 when we had the recession, when people would downgrade kind of their consumer expenses for themselves and not cut back on things for their pets. So like I said, I think humanization of pets is something that is absolutely a long-term secular trend, and pet ownership is up and very strong. And healthy, organic, fresh pet food is just one way for them to to better take care of their pets.
What's the cost like for their placement within the stores? Because I've seen these at Petco and other places where they've got the big fridges. I mean, are they having to pay for that? Is it like trial, or do they have longer contracts with these retail outlets so we know they'll be there? How sustainable sort of is it?
So the fridges themselves, there's no actual contracts, but there is a switching cost. If you think of this from a perspective of a retailer, right? They've already committed this floor space to this fridge. In order for them to switch to a different brand or to get their own fridge in there, they would have to either put up the capital to spend to put the fridge in there, or they would have to go through the switching cost of bringing in another company, another fridge, and trusting that the productivity of that fridge is as high as the productivity of the Freshpet fridge that they've already proven over the last couple of years is a very productive asset.
Chris, before we let you go, is this longer term play? Is there an area you have in mind that's fair value for the stock?
At Kane Anderson, we're always longer term in nature. So we think over the next couple of years that this category is going to become a much bigger percentage of the overall pet food market. And so and Freshpet's going to be one of the prime beneficiaries.
All right, appreciate it, Chris Armbruster. We're going to trade it here. Really good stuff. I like it. A nice setup here